fuel prices. We saw the inflation rate for April coming down to 9.6%, and you're projecting 9.7%. Help us understand how this all comes together.
Well, absolutely. Ghana has become a net oil exporter since late last year. But what this means is that any incremental increases in oil prices means it's positive for them from a current account perspective. But in the real sector, it's a different story because as oil prices increase, the country has a deregulated pricing scheme, which means that the government does not have that much control over prices as opposed to Nigeria, where they have a regulated pricing scheme. So any increases in oil prices will immediately feed into pump prices and the consumer chain. So this, of course, will feed into the entire CPI basket and raise prices in the economy.
Okay, but in terms of inflationary pressure, I mentioned inflation at 9.6% for the month of April. You're projecting 9.7%, but with this new development, what kind of impact are you expecting this to have for the next inflation data?
Well, we expect further increases in inflation. So this simply means that the government is unlikely, the central bank is unlikely to have an inflation target. I mean, to meet its inflation, to make inflation fall within the inflation target and remain there. It's likely to be in the upper limit or around double digits, around 10%. Going forward in the coming months, largely because of this increase in transport prices. And then on top of that, you've got strong domestic demand, which is also increasing price pressures in the economy. And then you've got some weakening of the currency. We've seen the currency weaken in Q2 as opposed to Q1. In Q1, we've seen a slight appreciation of the currency, but since Q2, we've been seeing some depreciation of the currency.
Now, that being said, for inflation, I'm thinking, I mean, considering where Ghana is coming from, talking about inflation, 10% is probably something the government can live with. What do you think?
Well, I think it needs to, it's about the impact it has on other issues because it's to do with the trend. If you're saying that 10% is okay, well, in terms of the trend, it's upward. It's not within the inflation target of 6 to 9%, and they really need to reduce interest rates. So if they see the prices increasing, and we're already seeing increased risk aversion towards emerging and frontier markets, which suggests that you need to keep your assets attractive in the economy. This will make them more cautious in reducing interest rates. And they need to reduce interest rates because private sector credit growth remains weak. And at the same time, money supply growth remains weak. And they need to boost lending to the private sector. So it's creating a dilemma for the central bank.
Definitely, especially, I mean, for the monetary authorities. But on the fiscal side of things, it looks like things are picking up. I mean, looking at the projections for GDP growth for this year and next year also, and that IMF $198 million IMF program that seems to have paid off. But of course, still a couple of pressures, especially raising domestic revenue. I know that the government is still having some problem with that, and of course, the debt issue. So for you, to what extent, how much of a headwind or headwinds do you think those pressures are for for economic growth going forward?
I think that if prices continue to, as long as the transport price increase will definitely have a negative impact on inflation, and this on top of strong domestic demand and expectation of some softening of the currency, will see further upside risk to inflation, which could halt the central bank's easing monetary policy cycle. And if that happens, it will have some dampening effect on the overall GDP productivity of the economy. So we might see some slowing down of GDP growth in the coming months because consumers are now faced with higher inflationary pressures, and so it inhibits their spending patterns. And if that happens, then you expect consumption to appetite to wane, and then at the same time an increase. If the central bank halts its easing cycle, then it means that debt servicing costs will remain high. It's already high. Debt service to revenue ratio it's over 40%, around 44%, and that is creating a headache for the government. So they really need to reduce interest rates. And so, but if we see inflation going in the opposite direction instead of going downwards, slowing down, then it's likely to continue to have a negative impact on the fiscal sector.